When the biggest player in a market that's small starts stockpiling, you're not witnessing a sudden change in belief. You're watching the moment the smart money stops talking and starts taking. December 2024 was quiet on the surface. People were focused on holidays, year-end rankings, and the usual what's next financial chatter. But inside the COMEX warehouse system, something happened that should have been a front-page story. JPMorgan moved a massive block of silver, about 47 million ounces, into COMEX eligible inventory. Not paper exposure, not a headline trade. Actual metal, sitting under the COMEX umbrella, counted, verified, and warehoused. Their eligible holdings jumped from roughly 12.3 million ounces to about 59.4 million ounces in a single surge. That's one of the largest bank accumulation events since the last time silver went into full panic mode. And here's the part that matters. This didn't happen while the media was screaming about silver. This happened while the dominant narrative was the opposite. Stories about weak demand, muted industrial activity, and silver being stuck and uninspiring. That's what the public was told. Meanwhile, one of the most connected institutions on Earth was doing the biggest physical build-up in over a decade. When an institution does the opposite of the narrative, don't ignore it, watch it. Because this isn't speculation or rumor. COMEX warehouse figures are public. Anyone can verify changes in inventory through the CME's daily stock reports. The silver moved, the holdings changed. The shift is real. So the question isn't, did they do it? The question is, why now, and why so quietly? Because 47 million ounces isn't a rounding error. It's not a casual hedge. It's a meaningful percentage of annual global mine production. Roughly 6%, just like that, effectively pulled into one entity's not-for-delivery pile. If one player quietly acquired 6% of the world's yearly output of oil, wheat, or copper, you'd see non-stop coverage. But silver? Silence. That silence isn't random. It's strategy. When big institutions want to accumulate, they prefer the public to stay bored. They want the market calm. They want sellers comfortable. They want the narrative to feel safe. Because the best time to buy is when people don't feel urgency. And the worst time to buy is when the headlines finally catch up. This is the same pattern we've seen repeatedly. When banks and institutions want distribution, you get media support, analyst upgrades, a flood of it's time stories that make late buyers rush in emotionally. But when they want accumulation, you get nothing. No excitement. No encouragement. No coverage. Just quiet transfers, while everyone else is distracted. Now, it gets even more important when you understand where JPMorgan put the silver. Not registered. Eligible. That isn't just a technical detail. It's the entire signal. COMEX categorizes metal in two main buckets. Registered inventory is metal, available for delivery against futures contracts. It's the foundation that keeps the paper market credible. It's the pool the system relies on when someone actually wants the metal. Eligible inventory is different. Eligible metal is stored in COMEX vaults but owned by private parties, banks, institutions, wealthy entities. It sits there as a stash, not automatically for delivery. It can be converted into registered if the owner chooses, but the owner doesn't have to choose that. So when JPMorgan shifts that much metal into eligible, what are they really saying? They're saying, this is ours, it's here, and we're not volunteering it to satisfy your paper contracts. That is not the behavior of a seller. That is the behavior of someone preparing for scarcity, and the psychology of it matters because this is JPMorgan. We're talking about this is the same bank that spent years on the opposite side of silver. Traders caught spoofing, pushing prices down with fake orders, then canceling them. A major case. Massive fines. Prison time. The record is public. They were the house in the casino. They ran the mechanics of pressure. Now, they're stacking physical. When the house stops trying to keep the price down and starts quietly building inventory, something has changed. It doesn't mean they suddenly became moral. It means the board is shifting beneath the table, and JPMorgan wasn't the only signal in that window. On the other side of the Pacific, China disclosed a sharp change in precious metals activity through its official channels. In late December 2024, filings associated with China's Foreign Exchange Administration reflected around $8.2 billion in precious metals purchases in Q4. A dramatic jump from the previous quarter. At average silver prices around the low $30s during that period. That kind of money implies an eye-watering quantity of potential metal exposure. At the same time, China reduced U.S. Treasury holdings by tens of billions. That matters because it's not one isolated action. It's a rotation away from dollar-denominated paper toward hard assets. When sovereign entities do this, they're not chasing a weekend move. They're positioning for stability in a world that's getting less stable. Now, stack that beside what happened in the ETF world. During November and December 2024, the largest silver ETF saw major outflows, tens of millions of ounces worth of selling pressure. In a normal market, heavy selling like that should push price down, but silver held firm. So ask the obvious question. If a massive investment vehicle is seeing a wave of selling and price refuses to fall, who is buying it all? Because it wasn't magic. It wasn't the market being weird. It was absorption. It means large buyers were happy to take the supply being dumped quietly, steadily, and without needing a headline. This is one of the cleanest tells you ever get in any market. When paper sellers exit and price doesn't break, it usually means physical-oriented. Money is absorbing the supply under the surface. And that brings us to timing, because the dates are too clean to ignore. JPMorgan finishes the big inventory move in mid-December. China discloses huge precious metals activity days later, and then January 1st, 2025 arrives, a date many people ignored, but banks cannot. Because Basel III implementation pressures banks around unallocated precious metals exposure. The basic idea is simple. Holding paper claims without proper stable funding gets more expensive. Running heavy leverage against metal becomes harder to justify under tighter balance sheet rules. Banks don't like capital penalties. They don't like inefficiency. So what do? They reduce the risk before the rules bite. And if new standards make unallocated positions less attractive, there's one obvious response. Secure more physical, shift inventory, clean up the books, and get position before everyone else is forced to do the same. That's why the December move matters. If you believe this is just a coincidence, ask yourself a simple question. Why would a bank with the deepest data access, the strongest relationships, and the most experience in this space choose that exact window to execute one of the largest physical silver shifts in years? The answer is usually not because they felt like it. It's because they can see what's coming earlier than everyone else. Now, let's step back and look at the underlying math, because the math makes the behavior look rational, not mysterious. Silver isn't in a normal supply-demand setup anymore. Mine production has been flat to down in recent years, while industrial demand has surged. Solar is a major driver. EV growth is a driver. Defense electronics, advanced chips, grid build-out, they all pull silver. And silver is not easily substituted. Conductivity matters. Performance matters. Scale matters. That means demand is not just cyclical. It's structural. And supply is not flexible. About 70% of silver comes as a byproduct of other mining, copper, zinc, lead, gold. If those mines don't expand, silver doesn't magically increase. Even if price rises, supply response is slow. New mines take years. Ore grades decline. Production costs climb. And the easy silver is long gone. So you get a problem that markets hate. A commodity where demand rises structurally and supply can't respond quickly. That is exactly the kind of setup that creates violent repricing. And we've seen it in silver before. 2011. Wasn't that long ago in market memory? Silver went from the mid-20s to nearly $50 in a few months when physical stress collided with paper leverage. But here's what's different now. The legitimacy is larger. The players are larger. The leverage is arguably worse. Back then, the rally was often framed as retail-driven and hedge fund-fueled. Today, the signals are coming from sovereign behavior, institutional positioning, and structural industrial demand. And the paper-to-physical leverage ratio is still extreme. That's the real fault line. When too many claims exist on too little deliverable inventory, the market works only as long as most people stay in paper. The moment delivery demand rises, or trust drops, or counterparty risk becomes a headline, the system has to choose: deliver the metal. Or settle in cash. Or raise price until sellers appear. That's it. Those are the options. And when price is the rationing mechanism, it rarely moves politely. Now, the phrase $100 silver triggers two reactions. Some people hear it and think hype. Other people hear it and think it's inevitable. Here's the better framing. $100 silver isn't a prophecy. It's what can happen When a small market gets discovered by large pools of capital while supply is tight and the paper structure is stressed, silver is tiny compared to the capital that could move into it. Institutional money manages absurd sums. Pension funds, sovereign wealth funds, insurance pools, endowments. If even a small slice decides silver is a hedge, the price must rise because the market simply cannot absorb that demand at current levels. That doesn't require a mania. It requires recognition. And recognition doesn't arrive all at once. It arrives quietly. And then suddenly, because once you reach a certain threshold, everyone realizes the same thing at the same time. Physical matters more than paper, and when that realization becomes widespread, premiums expand, delivery times stretch, dealers freeze sales, and the spot price starts behaving like a reference rate instead of a real purchase price. If you've ever lived through a true shortage market, you know exactly what that looks like. The screen says one thing, reality says another. Now, I want to be very clear about what this isn't. This isn't a call to panic. It's not a promise of a specific date. Markets can be delayed. Rules can be changed. Governments can intervene. Unexpected supply can appear. Demand can shift. But the setup is visible, the deficits are visible, the movements are visible, and when a bank like JPMorgan goes from the force that pressured silver down to the force accumulating physical, that deserves attention, because they don't need headlines to move, they just need inventory. And they just showed you what they wanted. The bigger question isn't whether silver can move higher. The bigger question is whether everyday people notice the positioning before the repricing. Or after it. Because by the time the story hits the mainstream, the cheap metal is usually already gone. This is legacy of money, where we look past the narrative and follow the positioning. Because money doesn't announce its next move. It prepares for it. Quietly. Until it doesn't.